Very good evening to all of you. Welcome to today's practical session, which is session number 28 for the year 2024. Myself, Srijit Kakkar, and today is Sunday, 21st of July, 2024. And before we move ahead, let's also get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. Now, we recently started a WhatsApp channel which is where we keep you updated about our upcoming sessions, latest videos, or if you are coming up with any new tools, or even if you are coming up with some offers. So if you are interested in joining the channel, you can scan the QR code which is on your screen. Otherwise, you will also be able to find the link in the description. You can click on that link to join this channel. And yes, this will keep you updated with all the new features, videos, or schedules we are coming up with. All right, now talking about today's session. Today's session is the practical application of demand supply methodology. I'm pretty sure all of you know by now that we used to have a paid course for demand supply methodology, which I made as an absolutely free course some time back. So, yes, the course is available absolutely for free for everyone if you want to learn demand supply methodology. It is available in two languages, English as well as in Hindi. The links are available in the description. So, if you want to learn the complete methodology, you can go through the course content, but the course content covers the course in a theoretical way. And what we do is whatever we covered in the theory, now we cover it in practical application during these sessions, which I do once a week. So every weekend, I do a session where we take some practical examples for demand supply methodology and understand how it has to be applied and how we can plan trades very mechanically and rule based. Now, whatever practical examples I share with you, whenever they get triggered, we always start with the review of them. And we do have one example which got triggered during the week. So we'll start with the review of it. And once we are done with the review, then we'll start with our analysis for today. All right, so the one which is for review is from session number 27, which was the previous session. The session was taken on the 14th of July 2024, and this was planned as a type 1 trade for us. Now if you talk about the reward to risk ratio, when the prices came into the zone, you can see our opposing zone was somewhere around here. So even if I go with the original entry and the stop loss, we have 1 is to 1, 2 is to 1, approximately maybe 2.6 or 2.7 is to 1. So reward to risk ratio was not a challenge. And the next thing which happened was we also opened inside the zone. So if you have your order placed, you could have even got a better price, which will further reduce your risk and increase your reward. So if you talk about this as your target based on the better pricing which you could have got, your reward to risk ratio probably increases to maybe 6 is to 1 or maybe even 5 is to 1. So yes, you had the opportunity to participate, and you can see prices did went below the distal line, but since we always keep our stop losses a little below, the stop loss was not triggered. We have already started moving up. It has not yet reached 1 is to 1, but pretty close to it. But yes, like I was talking about, if you go with the give me a second, with the deeper entry, because that is where we opened, then in such a case, you can see you would have already got. In fact, let me do this. Let's hide this for a minute. Then you can see you already have a move which is a little over 2 is to 1. And you can see, like I was saying, that with the deeper entry, this is your 4 is to 1, 5 is to 1. So probably 6 is to 1 is what you can see as your target. But anyways, let's go with the original zone. And based on that, we have still not hit 1 is to 1 mark. So we'll still track this trade for the next upcoming few sessions, unless and until we get an exit on it. But definitely the distal line was breached, but the stop loss, which we always keep a little lower, was not yet hit. And the trade as of now is going in our favor. Again, going with the deeper entry. If you want to make it as a break-even trade, that can also be done, because you have already got a better entry. But again, the break even will not be this. The break even will be then based on this deeper entry which you would have got. So yes, that takes care of the only trade that got triggered during the week. And now that we are done with the review of it, we can start with our today's example. So just give me a few seconds. Let me bring that up, and then we'll start with our practical example for today. So just a few more seconds. All right, perfect, done. Great. So whenever we talk about trading, always say trading has to be a very mechanical and rule based process. Now, why it should be mechanical and rule based, I have explained this in a video, and the title of that video is How to Start Trading. In case you have not yet watched the video, the link is available in the description. You can go through that video. And also the process that I've explained in that video, do ensure you follow that process, because there is no bypassing it. Eventually you will have to go through that process. So the sooner you start, the better it is going to be for you. But what happens is, when you are starting, as a fresher, you're learning trading, or even when you have a lot of experience, but let's say you're learning a new methodology, it's not very easy to create a trade plan based on that methodology due to the lack of experience. And what I've done is, I have created a ready-made trade plan for you, which is what you can start with. But yes, as you start having more and more experience, you want to make some modifications to it, that can definitely be done. Now, this trade plan is a combination of two documents. The first one is your trade plan steps. You can also call it as the walkthrough or the flowchart, which guides us what we need to do as a demand and supply trader step by step. Now, all these steps, they have their own elaborate rules, which are available in the rule book. Now, during the session, if I'm talking about some documents, if I'm talking about some videos, not to worry where you'll be able to locate them. Just go into the description. In the description, all the links are provided. By using those links, you'll be able to access these documents. You'll be able to access these videos. So again, this rule book that I've shared with you is a conservative approach. With time, with experience, if you want to make some modifications to it, to make it better suit with your personality style, those modifications can definitely be done. But at least you do have a starting point which can help you in planning trades very mechanically, very rule based initially. So what is our step number one whenever we start planning our trade? So whenever we start planning our trade, our step one is to define the trade purpose. Now, what is the meaning of trade purpose? Trade purpose implies my expected duration of the trade, which is from the time you enter the trade to the time you exit the trade. Now, mind it, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So now the question is, why are we starting with the trade purpose as our step number one? And the reason we are doing this is because when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge is that I have so many time frames available to me. So how do I decide that out of these a number of time frames, which time frame should I be using for my analysis? And to overcome this challenge, we do not start by randomly selecting any time frame. We start by first defining our trade purpose, because we always want to follow a logical process. And that logic will be applying here is that the longer I want to be in a trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration of the trade, the smaller the time frame I should be using for my analysis. So what I have done is, I have divided these trades into four different purposes, and we call them as hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or maybe few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income is a trade which can last for a month or few months. Now, very important, by definition, I say daily income is a trade which can last for a day or few days. But when you're trading markets which are not 24-hour markets, we do understand that every day when the market opens, some symbols will gap up, some symbols will gap down. Now, because of this gap up, gap down, what can happen is, if you get a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we hold a position overnight, it has that inherited overnight gap risk, which we would like to avoid initially, because like I was saying, that when you're learning something new, you don't have expertise from day one. Initially, you're prone to making mistakes, and you might make some mistakes while you're doing your analysis. So that is why initially we want that we should be practicing risk management by not keeping hourlies and dailies as overnight trade, doing them as strictly intraday trades. Now for weekly, monthlies, anyhow, we are not expecting that we'll be getting the exit the same day. So here we have no choice, but we will have to keep these positions as overnight positions. But that does not mean that for weekly, monthlies, you cannot have gap against you. It can still happen. And the probability definitely reduces, because when you're doing weekly, monthlies, you're leaning against some bigger time frames, and like always say, the bigger the time frame, the higher the weightage. So that is where it is perfectly fine that if you want to keep weekly, monthlies overnight, but again, that does not 100% remove the risk of having a gap against you. It can still happen, but definitely the probability reduces. But as you have more and more experience, if you want to include daily incomes into overnight trades, that can definitely be done. There is no harm in that, but only do that once you start building up confidence in your analysis. So let's assume this is where I opt. I want to plan monthly income trades. Now, once I have selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. Now, demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. And what are the multiple time frames that we utilize? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supplies for our entries and exits. And the refining time frame can be used for multiple purposes like fine tuning the zone, different kind of entries like your type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Now, what are the different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what time frames I should be using? You get the answer from the next page, which is page number 31. Now mind it, this table is for NSE market, which is only open for about 6 hours 15 minutes during the day. But if you're trading markets which are open for longer duration, you can refer to page number 32, where I've given you another table, which can be used for commodities, forex, let's say cryptocurrencies, right? So if you're trading markets which are open for longer durations, look into this table. But for NSE specifically, you can look into this table. Now, since I opted, I want to plan monthly income trades. From this table, I got to know that as a monthly income trader, my time frames will be monthly, weekly, daily, 60. Monthly will be the higher time frame, which is used for curve analysis. Intermediate will be weekly, which is used for trend analysis. On the lower time frame, we'll be identifying our uh, ACTS. ACTS stands for stop loss entry target and size, and in this case it will be the daily time frame. And the refining time frame can be used for multiple purposes like fine tuning the zone, type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. So as soon as I'm done with my step number 1, I have the clarity to what time frames I'll be using plus what is going to be the purpose of each and every time frame. So my challenge number 1 is taken care. Now, the next challenge is, yes, I do know my time frames, but if I talk about the NSE exchange, we have over 2000 plus companies listed. So humanly not possible that I sit and analyze 2000 companies every day. So that is where our step 2 comes into play, which is now we need to select some scripts out of a bigger list, because if we have a small list, we can do our analysis almost every other day. But if I have to go through 2000 plus companies every day, not an easy task. Now, how do we do this? For this, we use certain computer programs which are called as scanners or screeners. And the way these computer programs, they basically work is that we input certain conditions into them, that these are the conditions I'm looking for. And then that computer program identifies that out of such a big list, which symbols are matching with these conditions. And whatever is matching with those conditions, it gets shortlisted for us, and that is how we get a smaller list. Now, very, very important thing which you always have to remember, irrespective what scanner or screener you're using, whatever results you get, you can never blindly buy or sell those symbols. So the screener is never telling you what you need to buy or sell. The screener is only helping you get a small list. Then you'll have to analyze that small list manually to see which one of these symbols they match with your trade plan. Whatever matches with your trade plan is an opportunity for you. Whatever doesn't match with your trade plan, you simply skip it. Now, a few examples of these scanner screeners. Example 1, if you go to our website, you will see under the free tab, I have created some scanners for you, which are based on some moving averages and help you shortlist some symbols. Second example, on my YouTube channel, if you search for scanner, you'll be able to find few videos, different scanners, different logics. You like any of those, you can use that. That example, on my YouTube channel, search for sector analysis, you'll be able to find a video on sector analysis, which can again help you in shortlisting symbols. Fourth example, again, if you search for top-down analysis on my YouTube channel, you'll be able to find a video on top-down analysis, which can again help you in shortlisting symbols. So these are 3-4 different examples of different scanner screeners, but you're not restricted only to these 3-4 scanner screeners. Let's look at few examples before we move ahead. So like I was talking about, that once you come to our website, under the free tab, you will see we have stock screener. Because I opted, I want to plan MIT trades, I can run the long scan and the short scan. So here you can see the long scan is not generating any result for me, and the short scan is giving me around 4 symbols. Now, like I already said, just because you're getting some results does not mean I can blindly sell these 4. Similarly, if the long scan was giving me some results, does not mean I would have blindly bought those symbols. So the job of the scanner is never to tell you what you need to buy or sell. The job was to give me a smaller list, and you can see it gave me a list of only 4 symbols. Now I can analyze these 4. If anything matches with my trade plan, I have an opportunity. If nothing matches with my trade plan, I don't have anything available to me. Now, many times what can happen is the screener might not generate even a single result because maybe nothing is matching with these conditions, or maybe the list might be a very small list. So if you want your list to be a little bigger, because having a bigger list definitely increases the probability that you might be able to find something which is an exact replica of your trade plan. So to do that, what you can do is you can see that I've given 5 conditions in this scanner. You can disable the third one, run the scan again, and I'll do exactly the same thing here. Disable the third one and run the scan again. So now you can see initially it was not giving me any results for the long scan, but now I have around 153 symbols. And if I go to the short scan, I have 5. So we have 153 plus 5, which is 158 symbols to look into. Now, yes, for some of you, this might be a very big list and you might want to have a smaller list. So those things can also be adjusted. Example, currently you can see the scanner is looking at all the symbols that are available in the cash segment. So if I want a smaller list, I can say, okay, I don't want from cash segment. Maybe I only want the symbols which also get traded in futures. I can do exactly the same thing. I can go to futures and I can run the scan again. So now you can see from the short scan, I have just one symbol. From the long scan, I have around 44. So I have 45 symbols to look into. So you can always make your list a little bigger, a little smaller by using different filters, using different scanners, whatever you feel is the right fit for you. And these are not the only scanners available to you. If you go to the screener section on this website, you can see you have over 150,000 scanners available to you. Some of them based on fundamental analysis, top left, candlestick patterns. If I go further down, bearish scan, bullish scan, then you have your range breakouts, then you have your intraday bearish, intraday bullish, crossovers. And this is just one website. If you do a Google search, you'll be able to find a number of websites, a number of scanner screeners, whatever you feel is the best fit for you. You can use that to get your list. Now, in this example, you saw we got a list of about 158, I guess, when we were not using any filters. Now, once you start analyzing these symbols, a few again challenges which you will face. Challenge number one, what you will realize is that in that list, majority of the symbols, they don't have any quality demand zones or supply zones on the lower time frame. And the reason for that is because all these scanners that we are talking about, they are either based on conventional technical analysis or based on fundamental analysis, which is why just because something is getting shortlisted does not guarantee that you'll have a quality area available to you using which you can plan your trade. Second issue is that some of these symbols which might have some quality areas, those areas might be far from the current market price, due to which you'll have a longer waiting period before the prices are back. And during that waiting period, whatever price action happens, it might even disqualify the trade setup by the time it is back into your zone. So these are some of the challenges we face when our scanner screeners are based on either conventional technical analysis or fundamental analysis. So what is the solution to this? For this, we definitely created 2 custom built tools. One is called as the alert service. The other one is the screener. Now, very, very important, again, I'll add, these are not call giving or tip giving services. These are also scanner screeners. Only difference is that these scanner screeners are based on demand supply zones. They are not based on conventional technical analysis. Now, just to quickly give you examples of this, if you talk about alert, how does alerts they work? So alerts, what they do is as soon as you have a formation of a demand area or a supply area on the chart, it immediately notifies you. And recently, we also upgraded this by giving an add-on where now you can have a bigger list of symbols which you can monitor constantly, and as soon as these zones are formed, you keep getting notifications from TradingView. Now, just as an example, we do have a demo channel of NSC for MCX and Forex. So here you can see I'm showing you the demos, alerts. So we only provide demo alerts for about half an hour during the trading day. And this is for NSE. So you can see at 11:15 we had a formation of drop base drop on ABB on the daily time frame. Similarly, you have on the 60 minutes time frame, 15 minutes time frames, again 60 minutes, then you have 5 minutes, you have 5 minutes. So you can see as and when these zones are getting formed, you keep getting these live notifications. And again, this is not a call giving or a tip giving service. This is more like a scanner which is telling you in real time on which time frame, on which symbol a demand zone or a supply zone has formed. Once you get that information, you will have to go to that chart. You will have to qualify that zone with your trade plan. If it qualifies, it can be an opportunity for you. If it doesn't qualify, it has no meaning for you. So that is your alerts, which basically help shortlisting as and when these zones are getting formed. The second one is screener. Now, what screener basically does is, if I show you as an example, like here you can see I have applied screener to the chart. And in the screener, I have given a list of about 40 symbols. So you're not restricted only to 40. Now, depending upon your subscription level with TradingView, right? You can have multiple layouts, you can have multiple chart layouts. So you can apply this n number of times to have a bigger list. But yes, if you are someone who's having a free account, then you will be having some limitations how many times you can apply this. So you can see after giving the list of 40 symbols, I have given the condition that out of these 40 symbols, identify the symbols where the current candle is within 1% proximity to a demand area or a supply area. So now you can see if I'm only planning long trades, I don't have to analyze all 40. It is telling me these are the only 3 symbols where we are closer to a demand area. So just as an example, if I go to JSW steel, you will see that JSW steel, the current candle will be close to a demand zone, and that is why it is getting highlighted for us. And just wait for a few seconds. You can see that is where we have our demand area. You can see the current candle is pretty close to it, and the indicator shortlisted it for us. Similarly, if I go to, let's say, HCL Tech, there also we should be close to a demand area. That is what the indicator is telling us. So here we do have a demand zone, and you can see my current candle is pretty close to it. It's shortlisted for us. Now, if I'm looking at it as of now, because I'm on the daily chart, it is giving me the results based on daily. Let's say if I want based on the monthly, I just simply change my time frame, and now it will give me the results based on the weekly time frame. So let's give it a few seconds to load, because it has to go through all the symbols. So can you see on the weekly, it is telling me HDFC Bank. So if I go to HDFC Bank, you will see that I will be close to a demand area on HDFC Bank. You can see that is where you have your demand zone, and we are trading pretty close to it. So that is what screener is all about. It has nothing to do with whether the zone was formed today or whether it was formed a week ago or a month ago or a year ago or a decade ago. As soon as we are in that proximity range, it will shortlist for you, and alerts will only do it based on the zones which are getting formed on the current day, which is the live session. So again, you have a number of options available to you. I showed you so many scanner screeners which are based on fundamental analysis, conventional technical analysis, 2 scanner screeners which are based on demand supply zones. The end result is that from our step 2, we need to get a smaller list. How you get that small list is completely your choice. A lot of options are available. The process can be as simple as I just want to analyze my Nifty 50 stocks, or maybe I have my own favorite list of symbols which I want to analyze. So choice is yours how you want to get that list. Tools, we have provided you a number of tools, right? So once you get that list, again, next step is to analyze them one by one. Whatever matches with your trade plan is your opportunity. Whatever doesn't match with your trade plan, you simply skip it. So let's assume that in this list, the very first one was ABC. So what am I supposed to do next? I need to go to the lower time frame. What is my lower time frame? We already got the answer from our step number 1, that as a monthly income trader, my time frames were monthly, weekly, daily, and 60, and daily was my lower time frame. So here lower time frame implies daily. And what am I supposed to do on the daily time frame? I need to identify zone, and by zone we mean any of these 4 structures. It can be a drop based rally, rally based rally, rally based drop, or a drop based drop. So let's go to the lower time frame. So as of now, you can see I have the demand and supply zone indicator applied. So I don't even have to identify the zones manually. The indicator does it automatically for me, and it is telling me that from the current candle, the nearest demand zone is this, which is a rally based rally. Now if I disable this, and if we just talk about price action, because like I always say that demand supply methodology is based on price action. And what do we mean by price action? Price action means the action done by the price. And what action can price do? Only 2 things. It can either move up or move down, cannot do anything else. But when it is moving in a narrow range, we call it as the period of pause, or we can also call it as the base. Now, initially, when we start learning demand supply methodology, our eyes are not trained to identify these structures. So to start training our eyes, we start with a concept which is called as boring exciting, because you will see majority of the zones can be identified based on boring exciting technique. Again, I'm saying majority of the zones. I'm not saying all the zones. So this is where it becomes a good starting point for us to start training our eyes in a very mechanical way. But once your eyes are trained, then you will be shifting more towards what the price action is showing me. So example, if I'm talking about this chart, you can see below the current market price, I can see we have a nice strong move. Before that, we had a period of pause. Before that, prices were moving up. So we have a rally-based rally structure, which you can also see visually. Now, if I apply the boring candle indicator, you can also see that this candle is boring. To the left, we have an exciting candle. To the right, we have an exciting candle. So the exciting candle to the left of the basing is your leg in, and the exciting candle to the right of the basing is your leg out. And now we have identified all the three components of a zone, which is leg in, basing, and leg out, and that makes it as the structure of a rally-based rally. So you can see, irrespective whether you were using price action, you were using boring exciting technique, or you were using our most advanced indicator, which is the demand supply zone indicator, which automates the process for us. We are focusing on the same area, which is this rally-based rally. So let's draw the zone. And now we have completed our step number 3, which was identify zone on the lower time frame. With the help of the indicator, it was again automated for us. Do we have a zone available? The answer is yes. And this is where now the demand supply traders, they make the biggest mistake. And that mistake is they find any demand area on the chart, blindly start buying. They find any supply area on the chart, blindly start selling, which is incorrect. You cannot blindly buy or sell at any demand area or any supply area. Once the zone has been identified, the next step is to qualify it. And for qualification, we have a 2-step process. Step 1 will qualify it based on certain conditions. Step 2 will qualify it based on the booster scoring. So the first thing we'll do is we'll check that the zone we have identified, does it qualify as a case of level on top of level? Now, if you look at the example which we just reviewed, we did the analysis the last session. If we would have not verified it as a case of level on top of level, we would have not shifted to the lower zone, and shifting to the lower zone helped us participate in that trade. So that is why it is very important to check these conditions, and if the zone gets qualified for us, only then we use it, otherwise we don't use it. So how do we verify whether a zone is a case of level on top of level or not? It's a very simple concept. If you have an intermediate time frame zone and the same zone divides into multiple zones in the lower time frame. So again, when your intermediate time frame zone is dividing into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate time frame zone, which we call as a coinciding level. So if we have a coinciding level, the probability is there that it might be a case of level on top of level. But if we don't have a coinciding level, it can never be a case of level on top of level. So let's go back and check whether the zone we have identified, does it coincide with any intermediate time frame zone. If I go to the weekly chart, you will see that on the weekly, we don't have any zone here, therefore it is not a coinciding level. And if it is not coinciding, it cannot be a case of level on top of level. So level on top of level is not applicable. Next thing we'll check is that is this zone because of a gap. Again, gap is also not applicable. Pivot non-authenticity, not applicable, because pivot non-authentic we only apply to drop-based rallies and rally-based drops. Currently, we are looking at a rally-based rally. And unstable equilibrium is also not applicable because the leg out is not going below the basing. If the leg out was something like this, then we would have called it as unstable equilibrium. In fact, if you look at this zone above, this is an example of unstable equilibrium. Can you see the leg out is going below the basing? So that is what we call as unstable equilibrium. This one is not. So yes, going back, none of these conditions are applicable, and if these conditions are not applicable, they cannot disqualify the zone, right? To disqualify, first they need to be applicable, then there can be two outcomes, either qualified or disqualified. But if they are not getting applied, the zone cannot be disqualified. So is the zone qualified for us? The answer is yes. So now that I know I have a qualified zone, again, does not mean I will blindly trade it. The next step will be the booster scoring. So if you talk about freshness, the zone is fresh. You can see after leaving the zone, price has never been back, gets a score of 3. Strength, now if you look at my indicator settings, whenever I'm using time frame which is daily and above, I like to keep it as good. If I change it to explosive, then you will see the indicator is not identifying it. So we know that we have a good move but not an explosive move, and for good move I'll give it a score of 1. Time at the zone, we only have one candle, gets a score of 2. Reward to risk ratio will be taking as an assumption. So it's a high quality zone with a score of 9. Definitely taking into consideration that we'll have good reward to risk ratio when the prices are back. Next, what is my location? If I go to the monthly chart, now we have taken this example many times when you do have demands but you don't have supplies. So what we can do is two options. Option number 1, I can say, okay, because I only have demand, I don't have a supply area, I can't do my curve analysis. And since I can't do my curve analysis as a very conservative trader, I will be skipping this symbol. I'll be moving on to the next symbol. So that's your choice number 1, which is the most conservative approach. Second is, okay, I can make some modifications, which should again be logical modifications. So that logical modification we make is that from the current price, if I try to identify where is the recent pivot high, because demand I already have. So now I need to understand where is supply. So if the prices move down from here, logically it has to be some supply, right? It's just that the supply is not visible on this particular time frame, but it might be visible on some other time frame. So what I can do now is I can use this as a reference point and I can do my curve analysis. So the only difference now is we don't have 5 divisions, we only have 4 divisions, which is very low of the curve, low of the curve, middle of the curve, and high of the curve. Very high of the curve is missing in this scenario, but we are still able to understand where we are located. And in this case, we'll say that we are planning our trade at middle of the curve location. Now, since we are middle of the curve is not giving you any favor, it is not even against you, which is why it gets a score of 0. Talking about the trend, the indicator is telling us we are in an uptrend. We have violation of 2 supply areas, which will be a score of zero point 0.5. Next is move from the zone. We need minimum 4:1 move. If I draw this to check whether we have a 4:1 move or not. So fact is we have been pretty close to 4:1, but not exactly 4:1. If you go exactly from the proximal and the distal, then pretty sure you'll be having a 4:1 move. But I always look from the entry and the stop. So since we have missed it by a fisker, I'll give it a score of 0. It's not a case of level on top of level. We have already verified it, not even coinciding. But for trap, I can give it a score of 1. And the reason for that is if I take a horizontal line, just give me a second. If I take a horizontal line, let's zoom out a little bit and just start pushing it up. Just a little above, you can see somewhere around here, I can see that this area has worked like resistance. This has worked like almost support, work like support, work like support, again working like support, acting like resistance, acting like support. And that is where we have this a nice and neat, clean looking area of support and resistance. So what is going to happen? People who believe in support and resistance as support, they would prefer to buy when the prices they come to this level. And their stop losses will be sell orders, which will be placed below this. And if we get a breakout, then people who also believe in breakout will also start selling. So we understand by the time we are into this area, we'll have a lot of selling coming in, and the people who are selling now are making two novice mistakes, selling after a decline in price, which implies they are selling at a cheaper price, plus in an area where chart has proven to us that back in history demand exceeded supply, which is the only reason for prices to move up. So yes, that possibility is there that this might work like a trap, for which I've given it a score of 1. So as far as quality is concerned, it's a high quality zone, but the probability is not really high. We only have a score of 1.5, which makes it as a high quality low probability trade setup, and high quality low probability should only be done as a type 2 or a type 3 trade. So after applying the boosters, we got to know this has to be a type 2 type 3 trade. Next, no matter how high the quality or the probability, we understand that any trade can be a stopped out trade. So we need to do our position size calculations so that in case the trade does not go in our favor, we do not lose more than whatever our risk management rule allows us to lose. So you'll do your proper position size calculation. Whenever the prices are back, you'll have to re-verify, does it still qualify based on your trade plan? If the answer is yes, you place your order based on the entry type. In this case, it's a type 2, type 3 trade. And once your order has been executed, the last step is your trade management, which we are seeing as if now in the case of the example that we started with. So what we do is that 1:1, we make it as a break-even trade. After that, if we get the opportunity to trail onto it, we start trailing onto it unless and until we get our exit. So this is how we plan trades, very mechanically, very rule-based. And that is what we do in these sessions. I share these examples with you. We do the analysis in advance because, like I always say, the methodology is such that we can pre-plan our trades, and whenever they get triggered in the future, we also review them, like we just reviewed the trade that we analyzed the last session. And yep, that basically takes care of our today's example. Now, before I get into the chat box and look into the questions queries I have, I would like to add, if these sessions are helping you, do hit the thumbs up button, like the video. And if you're not subscribed to my channel, please subscribe so that you get notifications whenever I am taking these sessions. If you're available and you can join live, you're most welcome. In case you're not available, at least you will get to know that today a session happened. You can watch the recording later. And if you have some friends, family members who are into trading or interested in learning trading, you can share the link to my course content with them. You can share the link to my YouTube channel with them. You can share the link to these live sessions as well. And again, I'll add the complete courses available in both the languages, English as well as in Hindi. So wherever they are comfortable with, they'll have both the options available to them. All right, so let's see what do we have in the chat box. So we are starting with a lot of highs and hellos. So highs, hellos to everyone. All right. So Mahinder, I guess I'm seeing you after a very long time, right? So good to see you again. I watched your videos for the new demand supply zone indicator and alerts on this. I am not sure if you offer this for the US market, not only the Indian market, since I live in the. See, this is the reason we actually started with this new tool because I used to get a lot of request that you need alerts, but you need it for different markets, which could be the US market, which could be the European markets, which could be any market. So now what happens is with this new indicator, you can set your custom alerts because previously you could only set one alert. But now what is happening is per alert, you can monitor up to 40 symbols. So yes, it is applicable to all the markets across the board, be that the US market, be that the European market, be that the Singapore market, right? Doesn't have any limitations. Whatever is available on TradingView, you can place your alert. So yes, it is universal across the board. You'll be able to use it. All right, so I have a question of level on top of level. Let's say it's demand. The upper demand zone must be fresh because if in your PDF criteria of level on top of level, the lower demand zone might be tested by the upper zone. No, it's not a criteria because many times what can also happen is, let's assume we have a rally based rally. Let's say again a rally based rally, and that's a case of level on top of level. And this can happen many times. Example is now the lower can be fresh, the lower can be tested. But when we are starting with the upper one, generally we are always looking for a fresh area. But yes, maybe you started with a fresh area, but eventually what happened was you planned your trade on the lower one, prices came to the upper one, tested it, and now the upper zone has been tested, but the lower one is still qualified for us based on our trade plan. So what do I do in such a case? So this can happen at times. Maybe the upper zone is already tested, right, by the time you were doing your analysis. So in this case, again, because we know that this complete area is also my intermediate time frame. So that basically tells me that my intermediate time frame is also now a tested area, because if this would have not happened, at least the intermediate would be fresh. So since the intermediate has been tested, now what we want to do is we have a negative aspect that the intermediate time frame is already tested. Now we need to have some positive aspects if I want to take this trade. Now in my example, what I generally try to do is if I see something like this, I would still be okay with planning the trade as long as my location is very low of the curve, right? Because now I know I have support of my higher time frame. So that is how I'm adding some positive factors. Now you can have different rules for it, right? How you want to add those positive factors. But yes, it can happen at times. Even the upper zone might be tested by the time you started, doing your analysis. Or maybe when you did your analysis, that is the time it was fresh, but eventually it got tested and you were not able to participate because you were still looking at the lower zone to get into that trade. So that can happen at times. Great. So how to join the demo channel? So the link to the walkthrough videos are available in the description for alerts and screener. In fact, what I can do is I can quickly show you here as well. So if you just give me a second. Right, if you come to our website under let me see, if I go to all products and you go to alerts. Okay, my bad. Let me see, where can I find it? Just give me a second. Let me find it for you. Just a second. Okay. There you have it. So just give me a second. So what I'm doing is I'm just giving you the link in the chat box. So that's the link which is for the alerts FAQ. And once you go here, which is alerts FAQ, you can see, do you provide alert service for demo? So that is where you have these links for the NSE for MCX for Forex. You can just click on it and you can join those demo channels, right? So that is where you have the link to it. All right, so that helps you with this query. Okay, let's see. If we get a case of unstable equilibrium, then what we actually looking at the refining time frame. All right, so the rule is available in the rule book, right? So the rule is available in the rule book, and this is where you have that rule. In fact, let me do this: unstable equilibrium, unstable So what we need is that on the lower time frame, on the refining time frame, we need to have a stable structure inside of it, right? So that is what it says. You need to have a stable structure inside of it. Now, just as an example, let's say if I was looking at this upper area, which is an unstable equilibrium structure, if I wanted to trade this on the refining time frame, which in this case would be the hourly chart, I would like to see, do we have a stable rally-based rally structure inside of it? In this case, the answer is no, we don't have that. So that is what we are looking at, right? So if we have a stable structure or not. So I'm just going to different time frames just to show you, what kind of a structure we are looking at. So maybe on the, now just as an example, can you see? We do have a rally based rally here. We also have a rally based rally here. Though I would have loved to see this on the 60 minutes time frame, not on a smaller time frame, but just to help you understand, that is what we want to see, a stable structure inside of it, which in this case is a rally based rally kind of a zone, right? So that is what we are looking at. So I hope that helps with your query. All right, let's see what do we have next. What is the demand supply mismatch? How to find these stocks? So again, I'm not very sure what you're talking about when you're talking about demand supply mismatch. The fact is, when we are looking at demand supply areas, we are basically trying to identify exactly the same thing, where we have more of demand or we have more of supply, due to which prices they shot up or the prices they started moving down very strongly, and that shows us the imbalance between demand and supply, which you might be calling as mismatch. But that is what demand supply is basically all about. It's identifying where that imbalance was. Why strength is 1? The reason why I've given strength 1 is because you can see that when I keep my indicator settings for daily time frames and above, I don't keep it as explosive, right? If I remove explosive, I mean, if I change it to explosive, then this is not getting identified. But if I give it as good, then it is getting identified. So I know it is a good kind of a strength, not an explosive strength. That is why I give it a score of 1, not a score of 2. Okay, so I'm confused on which methodology I follow, demand supply or Dow theory or price action or a mixture of all of this. So again, what you can do is you can try all of these, take a sample size of, let's say, 50 trades, try all of these, whatever you feel is working the best for you. That is the way to go, right? Instead of just randomly selecting anything, why not to try all of these on a big enough sample size to understand what works best for you, what is the best fit for you. That is the one you can go for. That would be the most, I'll say, mechanical way of choosing out of a number of methodologies. Okay, sometimes in all-time highs on higher time frame, we get a candle with a long wick and a small red candle. So that high is also considered a pivot high, or we consider the location as equilibrium. See, now what is going to happen is, if stock is making all-time highs, it's not that it will always keep going higher and higher. You will get some corrections. Now, if that correction is really nice, substantial correction, what I will prefer to do in this case is, even if you go to the rule book, you will see that I have given a rule, and that rule is that if a stock is making all-time highs, I am okay with planning a short trade as long as I see a supply zone has already formed on the weekly time frame. So if I see a supply zone on the weekly time frame, then probably I would take it as a reference point and I can do my curve analysis. In fact, let me do this all-time highs, all time. So that is a rule which I follow, which again you can see makes it very mechanical for me. So here you can see that for a script making all-time highs, no short trade unless and until I see a weekly supply zone. So that is what I will wait for. So even if, let's say, I have some correction, but I don't see a zone on the weekly time frame, I'll still use it as a reference point to do my curve analysis. But if I see, okay, I already have a weekly supply area, then I can use it to draw my curve, right? So that is what I follow. So if you want to use something like this, you can follow exactly the same rule, or if you want to follow something else, then it will be your call. But yes, I'm just showing you a way which makes the process a little mechanical for you. All right, so how do I calculate reward to risk ratio and option spread? So we're not getting into options as of now, but maybe sometime I'll do a session and do it. But just to simplify it for you, what we do is even when we are doing our demand supply, we know where the entry is, we know where the stop loss is, we know where the target is. So we use options calculator to understand what can be the premium of the option when it hits our stop loss. What can be the option premium when we are entering the trade, so when the prices are coming back into the zone. So you use those option calculators to understand your premium at the time of entry, premium at the time of stop loss, and premium at the time of target. And then you do the same thing, which is your your calculation for reward reward to risk ratio. So example, if the option calculator tells me that at the time you are entering, the premium will be 10, right? At the time you hit your stop loss, the premium might be maybe 9. By the time you reach your target, the premium can go to maybe as high as, let's say, 13. So now I know I'm taking a risk of 1 rupee to make 3 rupees on it, which is a 3:1 reward to risk ratio, right? So that is how you do the calculation. But you'll have to use an options calculator to understand what can be the possible premium for your entry, for your stop loss, and your target, right? So that's how you do it. There is a pivot break zone, but no curve support. Can I take that trade? So I'm not able to get that. There is a pivot break zone but no curve support. Okay, so see again, the first thing is you need to have a quality zone and you also need to understand where it is located on the curve. So if you don't know where you are buying or selling, we don't know whether we are at a conducive location or not. So in such a case, I would ideally like to avoid it. But there can be other factors because of which I might take the trade. So unless and until I see the complete setup, I will not be able to give you the correct answer to this query. Any advice which you might want to give to HIT traders? Yes, for HIT traders, first thing you need to be very, very selective because when you're planning HIT trades, you're leaning against very small time frames. So be very selective. And in fact, I have also given you a rule here that when you are planning your HIT trades, first thing is always use fresh areas for your curve analysis. And there is another thing which I've added, which is I don't know on which page it is, but I know I have given you. There it is. Can you see? No, this is from the HTF. There is a rule for HIT which I've also given. Where is it? So you will find it somewhere in the rule book, and that rule is that when you're planning HIT trades, also try to be in sync with the bigger time frames, which means, let's say, looking at the bigger time frames, let's say WIT trades or DIT trades, if I feel that taking a long trade is much more comfortable for me, then that is what you should be doing. And when you're even planning HIT trades, still have a little bit understanding of where those bigger time frames, your dailies and weekly demand supply areas are, right? Because most of the times, I won't say most of the times, at times what might also happen is that based on the HIT analysis, you might be at a very good location to plan a long trade, but as soon as you go to a weekly chart, you might realize you're trading inside of a weekly supply area, which now does not make it as a very high probability trade setup, right? So if you are a little in sync with some bigger time frames, increases the probability. And yes, you also need to be very selective with your zones. Thank you for answering my questions. I will drop a quick email to get additional information. Not a problem. Yes, you can always send us the queries, but the problem here is that the emails that we get are always attended by my support staff who are not traders. So if your query will be regarding any trading and analysis, they'll not be able to assist you with that. But yes, if it is related to our tools and how they function, they'll definitely assist you with that, right? So not a problem. You can always drop an email if it is regarding our tools and the functionality of it. Should we always look for fresh demand supply on intermediate time frame for checking coinciding or level on top of level? That is not a very major concern, because again, what is happening is, like already gave you the example, that if the intermediate is tested, then I can still look for some positive factors in different ways. So again, depending upon how aggressively or conservatively you are planning your trades, you can have different rules. Okay, these weekly live sessions are great. Thank you for making this course, and sessions available free for everyone. All right, thank you so much. I'm happy to know that these sessions are helping you, and that is the main idea behind these sessions, right? Because if they are not helping you, then there is no need for me to take these sessions. The only reason I'm taking these sessions is because I want these should help you improve your trading, improve your results. Or it's if an MIT zone is a novice gap, but at all-time highs, but then we have weekly supply zone forms, will it still be considered as a tradable zone? Because novice gaps are, see again, yes, novice gaps are allowed when you're trading all-time highs symbols, but as soon as now you have a formation of a supply area, now that tells me that supply has started coming into the market. That is the time probably I would not like to take that novice gap and plan my trade. But unless and until I see that weekly supply forming, I'll still be okay with planning a long trade at a novice gap. But once you see the formation of the zone, then I'll be a little hesitant, unless and until I'll say maybe that uh, zone is having maybe a good location, right? If it is very low in the curve, then I might not mind, right? But otherwise, if it is anywhere else, I would definitely be skipping that one. All right, so till when the novice gap be considered in all-time highs? Yep, so I just answered that, right? So I saw your question, the next question now, but I think I've already answered it. That as long as I don't see that weekly zone coming in, I'm still okay with taking that novice gap. But once I see that weekly zone forming, I know now supply is coming into the market. And now why I look at the weekly zone, because can you see when you have those corrections, we can have zones on smaller time frames which are getting formed during those corrections. So I want to see that on a bigger time frame, a sell-off has started happening before I make that decision. Okay, now I have some supply on the chart. I don't want to take the novice gaps, or maybe now even if I want to plan some short trades, I can start doing that. All right, great. So that answers, I would say, almost all the queries that I got for today's session. Again, thank you so much for joining in. I will be seeing you now next weekend. Until then, trade safe. Enjoy your Sunday evening. Take care. Bye bye.